So welcome one and all to First Friday 401k. As you know, we cannot have a First Friday 401k without a disclosure. So I'm Timothy Yee, a registered principal offering security and advisory services through Independent Financial Group LLC, IFG, a registered broker-dealer and investment advisor. Member FINRA, SIPC, Green Retirement Inc., and IFG are unaffiliated entities. We are not talking about specific investments today, but rather I will use examples. I am not recommending anything. As always, past performance is no guarantee of future results. So today I just wanted to chat with you folks about asset allocation and diversification. Perhaps not the most exciting of topics, but it is a topic nonetheless that is frequently mentioned um, in modern portfolio theory and pretty much in any portfolio construction. But what exactly does it mean? Well, in its simplest sense, and again, we are joined by Paul and Nick from HIP Investors. They're very experienced investors as well. So, gentlemen, feel free to jump on in. To me, it's just talking about risk. That's all this is. We all know the adage, don't put your eggs in one basket. Intuitively, it makes sense. All you have to do is have one trip and fall, and all your eggs go flying, they break. So, this is about risk management. And that's all asset allocation and diversification, I feel, is it's a prudent way to manage your portfolio and try to the extent possible, eliminate risk. I will say it is not possible to eliminate risk entirely. And there are many reasons for that that we'll talk about, including overlap of stocks. So we'll dive right into that. Let me get back to here. There we go. All right. There we are. And make this a little bit bigger on my side. Perfect. So the first thing I'll point out is this, commonly referred to as the Callan chart. And it takes a look at what sector of the stock market did well in any particular year. So if you take a look at the top here, you can see 2005 through 2024. Up at the very top in 2005, something called EM did very well. It had a return of 33.8%. But if you look at 2008, that very same brown color EM had a negative 50%. Now, for fun, we could always take a look at this and see if any of you actually see a pattern to this. One of the best answers I got was from an employee who said it looks like one of those ink blot tests by Rochart. So, um, and EM, exactly as Paul points out, is emerging markets. Now, given how dense this chart is, yes, we're using abbreviations. So you will see real estate investment trusts in purple has been abbreviated to REITs. International stock has been truncated as well. I think what the chart really is saying is that there is no one category that consistently is at the top. And I'm going to pop this into the chat box. So anyone who wants to take a look at this, they update it frequently. And you can see more expanded versions and versions going back through time. Point being, there is no one category or investment, whether it be this green thing called bonds or this light green one called tips. Nothing ever seems to be at the very top. And so this is the argument for having a little bit of something in everything. I guess in Las Vegas, what do they call that? Bet the table? Anyway, yeah, put your money on all numbers and hopefully your portfolio will do well. As I've said repeatedly, past performance is no guarantee of future results. But putting your eggs in one basket and always hoping that the brown color emerging markets or large growth, which is large US companies that do well in an up market, hoping that they'll do well, that's never an answer. Even something like cash, if you look in 2022, having your money in a savings account beat the stock market. And this isn't a theoretical exercise, folks. Again, take a look at these returns. In the bottom of 2008, you had a negative 50% return. Yes, you effectively lost half of your money on paper, but the very next year, that same category was up 70%. So that is my quick take on the reason behind diversification. Now, as we break it down, the simplest way that I've come up with is the Morningstar style box. Morningstar is a free service out of Chicago for the most part, and yeah, they rate all stocks, all stock mutual funds, and all bond mutual funds on a 5-star scale. Any of you who have been in my individual meetings know that I talk about the star ratings. And yes, 5-star means over the last 3 years, you've done a good job. So 1 star on a rolling 3-year average means you haven't done that great a job. Three is average, two on either, and four on either side. But the star rating is so built into investment culture that if somebody says to you, buy my mutual fund, a perfectly valid question is, well, how many stars do you have? 5 stars? Great, let's start talking. 1 star? Not really sure what we're talking about. So that's the first part of the Morningstar. And then the style boxes, let me see if they have a bigger one. There's the bigger one down here. Can everyone see that at the bottom? The little green squiggles and all. Yes, okay, I got the thumbs up. All right. So down at the bottom, these are the Morningstar style boxes. I know. First time I drew this for a client in 2011, they said, "Oh, great, we're going to play tic-tac-toe." No, not tic-tac-toe. But you can see here we have small, medium, and large, and then value, blend, and growth. What we're looking at right now is a stock Morningstar style box. These are for stock mutual funds. What the Morningstar box is doing is looking at small companies, medium-sized companies, large companies. These are here in the United States. And then value, blend, and growth. Now,
Excuse me.
yes.
Laura's asking if you can zoom in a bit on the box.
Oh, well, thank you. Again, Rose and James are keeping an eye on the screen because I'm busy talking. My apologies. All right, let's see what I can do here. It looks like I am going to be joined by Chief Love Officer Kaboom. So she is feeling very much left out. So for those who have not met Chief Love Officer Kaboom, here she is. She was tapping on my leg and wants to join in. So she does have an official role on the website, Chief Love Officer. So hopefully you can see this now. And let me give it one more squeeze. There we go. So small companies, what exactly is a small company? Now, when I first heard about this in the early 90s, I'm like, yeah, I know small companies. It was called Lee's Sandwich Shop. And they were down on the corner and they had one store in San Francisco at the corner of Market and First. Not exactly what the market defines as small. Typically, the market looks at small companies as 200 million to 3 billion in annual revenue. So I guess if that's small, my company, Green Retirement, must be ultra micro. Medium-sized companies or the mid are 3 to 10 billion, and large companies are 10 billion and up in revenue. So as you think about diversification, a natural way to think about it is I should have some holdings in small companies, medium companies, and large companies. That certainly makes sense. But I also remember back in my days in corporate America where a customer came in and proudly showed me her statement to tell me she had a diversified portfolio. Yes, she owned 5 different companies. But when I looked at the company names, I realized that all 5 of them were in technology. Yeah, that's not really diversified, folks. That's the same sector over and over. So, um, we'll talk a little bit about that later on. I know James wants to talk some about the sector diversification as well as the over-concentration of the Mag 7. So small, medium, large, I think that intuitively makes sense. Next up, we have the value, blend, and growth. Now, what does that mean? Value typically are undervalued companies. I remember in the good old days that Ford wasn't doing so well. Matter of fact, they brought Bill Ford back in trying to revive the company. One person joked that if you open a bank account, they'll give you a truck because they couldn't sell them. Would you like the F-150 or the 250? Ford is certainly not necessarily a value company, but value simply is a way of saying undervalued relative to where the analysts feel they should be. A growth company, well, growth companies generally do well in a growing stock market. I remember when Rose and I were visiting a client in New York, and the line at Apple was around the block. Apparently, the new iPhone was being released, and people were camping out overnight just so they could get in there and say, yes, we got the first one. So, Apple at that time might have been seen as a growth company. And a blend mutual fund is a combination of the two. It has both value and growth companies. So, as you can see here, if you wanted to diversify, you should have small, medium, large, and then, of course, some large company. You should have some growth companies, both in the small, medium, large category, and some value companies. Now, a typical 401k has, I would say, 4 or 5 investments that people choose. But here we could see somebody going completely crazy, possibly choosing 6 just in the stock category. So far, so good, folks. Now, to make your head spin, this is just the US side, all right? We could do the same thing on the international side. There are large international companies, medium, small. There are large international growth companies and value companies, medium and small. So to truly diversify, now we should have what, 1, 2, 3, 4, 5, 6, ignoring blend, which is a combination of the two. So we should have 6 categories for US, 6 for international. Now we are up to a 401k that has 12 holdings. How's that for quite a diversified portfolio? And then the same thing happens on bonds. Let me just double check the chat box. I think I put the Callan chart in, but I did not put in the stock Morningstar. So excuse me 1 second. Need to shift Chief Love Officer Kaboom so I can actually type in the chat box. There we go. So that's the Morningstar style box for the stocks. And now I'll pop in the one for bonds. Sometimes Zoom just sits right on top of the URL bar. Go. Right. So there's the link for the bond style boxes. Similarly, on bonds, you have the same tic-tac-toe style. Let me just zoom along to the bottom here. Oops, daisy, did I pass it by? I must have. My apologies. There we go. All right. Click. So in the stock category, we had small, medium, large. Well, with bonds, we don't necessarily rank it that way. We look at credit quality. So at the very bottom where we had small, we have low credit quality companies, then medium credit, then high credit. Credit is typically defined by groups like Standard & Poor's, Moody's, Fitch. Those are some of the credit rating agencies that come to mind. But they look at the company and they're basically evaluating the company's ability to repay. So a low credit quality company would probably be charged very high rates or would have to offer very high rates on their bonds to get people to invest in them. Again, a bond, remember, is a loan to a company or to a municipality, what have you. The idea of the loan, though, is that you want to have a fair rate of interest paid to you. You want the interest paid back over time, then eventually you would like to get your money back, and then you lend it out again. Stock investing, on the other hand, you're buying the companies and hoping that they will go up in value. There is no guarantee that they will go up in value. So we have already, to create a diversified portfolio just in the stock side, we have 12 different categories that we would have to look at. Small, medium, large, value and growth, both US and international. Now we really muddy the waters by looking at this from a bond point of view. Perhaps a diversified portfolio should have low, medium, and high credit quality companies. And then you can also look at the length of the bond. So we have short-term bonds over here, then medium-term bonds, and then very long-term bonds. In this case, they're defining it by interest rate sensitivity, but the general consensus is short, medium, and long. So, if you want to have a truly diversified US bond portfolio, you should be choosing something from all nine of these categories. 12 stock portfolios that you need. Now I've added on nine more. We're up to 21. And of course, you know where I'm going, which is that this is only on the US side. If you really want to diversify your portfolio, now you need to add nine categories for the international bond market. I think we're up to 30 if I did the math right. Could you imagine a portfolio with 30 different mutual funds? But in theory, that would be the true idea of diversified. And the reason, again, for diversification is we are trying to get rid of risk. We are trying to put our proverbial basket of eggs, we're trying to spread it out so that we don't have eggs in one basket. Hopefully, some part of the market will go up. As I showed you in the Callan chart, which again is in the chat box, and let's see, just get that again since we had a newcomer join us. Oop, there we go. Pop that back up. Close that, there we go. And then there we go. So again, if you want to have a diversified portfolio, technically we're up to 30 different portfolios that you would invest in, whether it's 30 different mutual funds, exchange traded funds, what have you. I would say it's fairly complicated. Now, one of the things I learned early on, junior advisor James, when he was very little, he was the one who pointed out to me that Disney, now Disney, I think we would all agree, is a US company. They're down in the Anaheim area. But James was the one who pointed out to me that there really is no such thing as a US company. That's true. Disney does business around the world. If you want, you can actually go to Disney World in Shanghai. There's one in Hong Kong. There's one in Paris. You can buy Mickey Mouse dolls pretty much anywhere you go. So is Disney truly a US company? On the embarrassing side, we were making a trip to Belgium. I had packed up my laptop, was pretty happy about myself. Got to the hotel whenever we did, and I wanted to check my email. Lo and behold, my power cord had been left behind. Yep, the power cord was still plugged into the socket, and I was not particularly happy with myself. Paul makes a good point. The S&P 500, which we typically think of as the top 500 companies in the United States, half of them are getting half of their revenues coming from overseas. In this case, my first stop in Brussels was not some nice tourist attraction or coffee shop. My first stop in Brussels, and my wife was not happy with me, was the Apple store so I could buy a power cord. But Apple, folks, a company based in Cupertino, California, doing business around the globe. Accordingly, if you have an investment in US large companies, you probably would have Apple. We can also dive into sector, and I know, James, you wanted to comment on this a little bit of sector diversification. You would probably also see Apple in US technology companies. You might see Apple also in large US companies, or excuse me, large international companies, because again, Apple is doing business around the world. Questions, folks, on diversification and asset allocation? I'll check the chat box. Quickly take a peek. I don't see any. Yep, Rose wants to say something. Go right ahead.
I just want to check in and considering that we have Paul and Nick here, are you going to be uh, touching on models? Because for some of our participants, they probably wouldn't want to have to look into making sure that they fit all of those style boxes and would rather have models that they can actually use. So I'm just wondering if that's going to be part of the
It
conversation,
is.
or
It
if we
is at
can
the end.
make
Yeah.
use of Paul and Nick being here. Thank you.
No, it definitely is. That is coming towards. I've got a couple more technical things that I'm going to hit on. I know James wanted to comment on sectors, and then certainly we will talk about models. Paul, not to put you on the spot, and I'm very well of compliance, but at the same time, I'm sure you'll have a little something to say at the end on the models. I hope that's okay with your compliance team. I
Yes,
don't
it
want to
is.
cause any excitement. And folks, again, anything I show you here as an investment is an example. I am not recommending anything. I can't recommend anything. Recommendations can only come about through risk analysis, due diligence, and getting to know somebody. The next part that I'll take a look at, how exactly do you know what you own? Well, I'm going to give you an example here. This is an example. This is a US large cap mutual fund. And when you bring up the mutual fund, we talked about the Morningstar style boxes. Right here, you can see it's a large value. So Morningstar puts it right out in front. This is what category you're in. And this is the star ranking that I talked about. But what exactly are you owning in large value? One easy way to do it, of course, is to go to the Parnassus website. Parnassus is the company that manages this investment. And you can take a look at the investment holdings there. You can also go to Morningstar and click on the portfolio button. One thing I will say, though, is the holdings are out of date. They are not being tracked real time. They are usually as of the end of a quarter. So just keep that in mind. When you click on the portfolio button, go, you can see that they have 45 companies here, and there we have some of the companies listed. This is the first 10, and you can click on through the 5 pages there to see exactly what you hold. And this is an easy way to see whether or not you are diversified. If you're starting to see the same companies over and over, I would respectfully submit the answer is no. But Apple is really a good example, folks. I think it's very hard to diversify in the large cap space. Now, if your portfolio consisted entirely of large growth and small cap value, maybe the answer there is yes. But I would have to say, generally, you're going to start to see the same names showing up. International large companies, I would expect to see Taiwan Semiconductor here. And it's also showing up in this portfolio, which is US large. So again, it suggests to me that Taiwan Semiconductor is a company doing business in the US. And of course, indeed they are. So far, so good, folks. James, did you want to jump? Oh, Nick, did I see a hand there? Or was that a thumbs up? Thumbs up? Okay. All righty. Good, good. James, did you want to jump in on sector diversification in the MAG 7?
No, my thoughts really were talking about how to protect against potential geopolitical risk that we're facing with the war.
Okay. Go
One,
ahead.
the reason why I was thinking about diversifying or making sure our clients understand diversification is a lot of the chips that these large technology companies are relying on come out of Taiwan Semiconductor. Um, and a lot of those plants, a lot of their plants run on LNG, liquid natural gas, to power them. So, given the situation that's going on with the Strait of Hormuz, there are potential downstream effects that I don't think we've seen impact the market yet. Additionally, the response from Iran has affected the GCC countries, as we have seen, many of which their investment funds, their national investment funds, invest in our stock market, specifically in these data centers, and as well as other sectors of our market. So that will also have potential downstream effects that I've been mindful of in my role as analyst here at Green Retirement. That's just, yeah, my contribution on that topic. Others may have thoughts on it, and certainly it is something that a lot of people are covering, but it is something to keep in mind.
Yeah, it's a very good point, James. You can't look at the company just in a silo and see what the company does. In this case, I was not aware that the semiconductor companies in Asia were being powered by liquid natural gas. But this is where you can really get into a deep analysis on the company, on its supply chain, and better see where the risks are.
And to
Paul,
clarify,
actually,
Timothy,
go ahead.
it's not simply liquid natural gas as a 100% part of the whole.
Mm,
It's obviously a part of it, and it's significant enough that it might make an impact, but we will see how Taiwan specifically adapts.
yeah.
So,
Yeah, that's a good point. It's not all or nothing, but we are starting to see the shocks. On May 5th, we went down to our local burrito shop, and yeah, they had a sign on the cash register. It said, owing to increased beef prices, the price on beef burritos, beef tacos, and everything else has gone up. And they had how much it had gone up by. Hopefully, that since the sign is paper, that's just temporary. But yeah, anyway. Paul, why don't I take a break and turn the floor over to you? Do you want to talk about models and why, respectfully, it's a little silly to have 30 portfolios, 30 different mutual funds, and a 401k, and how we might be able to do that with a model? Paul and Nick are from Hip Investor. Green Retirement and Hip Investor are not related companies. They are not related to Independent Financial Group. Any examples they are giving are just that, examples. We are not recommending that anyone do anything. For those of you who have HIP models, we do offer them inside the 401k. And if you would like to see them inside your 401k and they are not, again, we are bringing this to our plan sponsors and letting them know that these models are available. Paul's kind enough to put the HIP Investor website into the chat box, and I'm also happy to talk with you folks offline about adding the HIP models. And yes,
Um,
we will be talking about fossilfreefunds.org as another way of diversification. But Paul and Nick, the floor is yours.
Great. Thank you. Thanks, Timothy, Rose, and James. Hello, everybody. And I'm Paul Herman from Hip Investor. Nick Gower from Hip Investor is also on the line. We're here because we're clients of Green Retirement. We have a Green Retirement managed plan inside Hip Investor. And as Rose and Timothy introduced, we are the manager of the HIP fossil fuel-free portfolios. So some of you may be aware that there are target date funds from Fidelity or Vanguard or other providers. And what they do is pick a date in the future where you might need that money in 2030, 2040, 2050 for retirement or school or other needs. And none of those, almost none of those, are fossil fuel free. And so if you would like a sustainable portfolio, and if you would like almost a push button portfolio that makes it simple, we've created what we call target risk portfolios. So the highest risk is 100% equity and no bonds in that portfolio. And there's an 80%, a 60%, a 40%, and a 20%. So in general, if you're investing for 10, 15, 20 or more years, you can take more risk. That allows some of those market fluctuations that Timothy and Rose and James described from the grid of all the different types of investing. And what we do is we do that for you for the HIP fossil fuel free portfolios. And the goal is for whatever funds go in that portfolio is for to minimize or in target having zero going to coal, oil, or gas. So companies like Exxon and Chevron are typically not in the portfolio. To have none going to fossil burning utilities. So Nick lives in North Carolina. The biggest utility in North Carolina is Duke Power. Duke Power has a long history of burning coal. When you burn coal, you also end up with a coal ash pond not far from the power plant. And when there is a hurricane or flooding or a climate threat, those coal ash ponds can get into the water, the water supply, the well water, and they frequently have mercury in them that kills fish, that gets into the food system. And so it's disruptive to people's health, it's disruptive to environmental health and the like. Where we have been doing additional diversification globally is investing in the EM, the emerging markets, and the DM, developed markets internationally. And now there are increasing number of funds that are sustainably oriented, including being fossil free, while also having being internationally diversified. So through all of the recent ups and downs of the market from the latest political administration, being globally diversified can be helpful to reducing your risk over the long term and tapping into opportunities. So James mentioned Taiwan Semiconductor and also mentioned what is the energy source, but also what is the political risk, since Taiwan is in the eyes of China that wants to reunite it with mainland China. So that is a big risk in holding Taiwan Semiconductor for example. So overall, think about what timeline you have and therefore what risk you can take. The longer the timeline, the more risk. The shorter the timeline, the less risk. There's a HIP fossil fuel portfolio that is either in your 401k or could be added to your 401k. And then throughout the year, I think we always talk about dollar cost averaging. So each payroll period, you can put that in. A HIP portfolio. And then when there's changes over time, either a fund strays from being fossil free or there's more different diversification needed. That's what we do and manage that for clients, advisors, and 401k plans.
Nick, anything you'd add, please?
Paul kept us mostly focused on the fossil-free portfolios, but I also put a plug in for the climate solutions investment strategy, of which I'm a co-portfolio manager with Paul Herman. But it's been very exciting to see that strategy weather some of this more recent volatility, given its lack of reliance on fossil energy and fossil intensity. It not only prioritizes clean energy, but also firms that are creating opportunity for energy efficiency, like ABB, and manufacturing firms that are operating with lower energy intensity.
So another example would be Trane Technologies, Trane. Trane makes heat pumps. You may have a heat pump in your house or your business or your office. A heat pump is a very energy efficient way to cool it in the summer or to heat it in the winter. And so that continues to spread because businesses and people want cheaper energy, more affordable energy. And those are companies producing those solutions. So climate solutions, products and solutions has actually not been as volatile during the U.S.-Israel war on Iran and Lebanon. So customers like solutions that not only are good for the environment, but are good for their pocketbook.
I appreciate that, Paul and Nick. Thank you. So as you can see, folks, diversification goes beyond where we started with the Callan chart. The Callan chart simply shows you over a 20-year period of time what has performed well each year, correspondingly what's at the bottom, and of course the in-betweens, and there is no consistency as to which is at the top or the bottom. Morningstar, of course, with their style boxes, both in terms of stocks and bonds, and then international stocks and international bonds, would advocate for having a very spread out portfolio, as I calculated it, 30 different mutual funds or exchange traded funds. Paul, of course, is simplifying that by including it in models and then trying to eliminate the risk from fossil fuels. And James, of course, has pointed out the supply chain risk. And you'll see his comment on the Taiwanese companies and how much they're getting from liquid natural gas. So when we talk about risk, which was my original premise, don't put your eggs in one basket. There are many different kinds of risk. The stock portfolio, we're trying to diversify as well as the bond portfolios, but I'd like to show you two more technical examples, but bear with me and I know some of you, like me, may have bad memories from um, statistics class. The first one, though, that I like to talk about is beta, and I will pop this into the chat box. And once again, the Zoom bar just seems to land right on top of things and never quite understand it. All right, there we go, chat box. So there's beta, and then I'll move the bar, there we go. Okay, and pop this into the chat box. No, not that. There we go. Oop. Standard deviation. All right. So two other kinds of risk that I'd like to talk about. And again, this is something that you can look at. The first is beta. The next one is standard deviation. Beta is simply looking at your portfolio and saying, are you marching along with the general market, which would be a beta of 1.0? In other words, as the market goes up and down, your investment will do the exact same thing. If it goes up 10%, your investment is up 10%. If the market is down 10, your investment is down 10. Correspondingly, a beta above 1.0 would exacerbate those. So if you had 1.2, your volatility up and down would be much more. Increases in the market would generate larger increases in your investment, and correspondingly decreases in the market would be magnified in your portfolio. You can also see betas that are below 1.0, which means that the up and down swings are going to be less. So if you wanted to, you really could take your portfolio and say, what is the beta of each of my underlying portfolios, and are they correlated together? Yes, beta and standard correlation. The correlation coefficient, I thought I had seen the last of that in statistics class. Unfortunately, no. Standard deviation is an interesting one. I don't know if you know, folks, but if you take the temperature in New York City, all 365 days, the whatever the high and low is, and average it out, and then add those numbers together for the full year, 365 days, divided by 365, and then you did the same thing for San Francisco. The average temperature, the days high and low over 365 days in New York, when summarized as one number, is actually roughly the same as San Francisco. Now, most people would agree that the average temperature in New York, if you're there during the summer, it's nothing like San Francisco. And during the winter, of course, New York is getting snow. Maybe in San Francisco, we're having rain and fog. So standard deviation is yet another measure of risk, and it's something that you can look at in your portfolio. It simply says if you have an average number, how far is your investment swinging from the average? So the higher the swing, the greater the variation. The smaller the standard deviation number, the closer it tends to stick to the median. Again, if you think about San Francisco weather, it tends not to deviate. Maybe we get the 50s, the 60s. Rarely do we get in the 80s and 90s. But in New York City, yes, I remember the humid summers there, and I certainly remember the snow. So giving you an example, again, when you look at this, and I'm sorry to say this for the third time, this is an example. It's not a recommendation. You can take a look at the risk category on Morningstar, and you can look at it. I typically like to look at it over a 10-year period. You can see right here what the beta is. The beta on this fund is a little bit over 1, which means that the market it's being compared to, as the market goes up, this fund will go up more. Correspondingly, when the market goes down, this fund would experience a bigger downward drop. And you can see the standard deviation as compared against the category and the index. So these are yet another way to measure risk, beta and standard deviation. Now, you're probably thinking this is just way too much. 30 different portfolios plus beta and standard deviation. Again, this is why people hire professional managers to manage portfolios and try to make sense of this. There are no guarantees that a professional manager is going to make money. That's a given. Past performance is no guarantee of future results. The final thing I would like to point out to you in terms of risk, because that's really what this whole conversation is about, managing the risk in your retirement plan or your outside portfolio. The final one that I'd like to point out to you, again, this is a free tool. It's called fossilfreefunds.org. I'll pop this into the chat box. And thank you, Paul, for including the beta definition. You can also pop in standard deviation. So way back when I was a beta tester in 2014 on this website, it's produced by a nonprofit out of Berkeley, California called As You Sow. And not surprisingly, folks, As You Sow, Green Retirement, IFG, and Hip Investor have nothing to do with each other. We're all separate companies. Yes, we do use each other's tools or knowledge, but we have nothing to do with each other. We don't work for each other. Back in 2014, the focus was on climate change. The question that was being asked by the website is, are you investing your retirement savings in fossil fuels? Because that's a risk, as James has pointed out, as Paul's pointed out. Paul, actually, I think I heard, if I got it correctly, that climate change is impacting mainland Europe to the tune of extreme heat. And I think I've seen some of the heat waves rolling through France and through Spain. So, yeah, folks, there's real risk. If you can't grow grapes, for example, which France certainly is known for their wine crops, do you keep moving your grape crops north? Well, now you're getting a different kind of wine, so that impacts the wine industry. Use that just as a quick example. In any case, in fossilfreefunds.org, you may look up what you hold. So you can type in the name of your investment. This is purely for research. You still have to make your own decision as to what it is you want to do. But I'm going to use a popular investment. I am not saying you own it. I'm not recommending it, but it is one that you will frequently hear. It's called the Vanguard 500 Index. And way back when, as we thought about how to present the data, the first thing that naturally came to mind is, well, simply state it as a number. How much of this investment is invested in fossil fuels? 106.84 billion. Now, we also wanted an intuitive way to report the data, and there we have it with a letter grade. We can quibble about the scale, but yeah, maybe it's a C, maybe it's a D, maybe it's an F. I think most people would agree this isn't an A, but those are semantics. And then, as one of my CFOs joked, he wasn't a real big fan of numbers, so here we have pictures of the companies that are being invested in. Again, this is an example, folks. It is not a recommendation. Since that time, since 2014, we have moved on beyond just fossil fuels. I'll show you what the full report card looks like for this investment as we look at other areas of risk. It is not pretty. I frankly would call it a merry bunch of C's, D's, and F's with a couple of B's thrown in. But each of these areas may be looked at as risk. For example, tobacco lawsuits. Instead of adding value to society, no, the money or trying to increase their stock portfolio or price, the money is being tied up in lawsuits. And if you want to talk about tobacco risk, I saw an interesting thing from Philip, I think they're called Philip Morris. They actually wanted, if I read it correctly, they wanted folks, the legislatures in England, to say that tobacco is a poison. Now, given that Philip Morris produces tobacco, why exactly are they doing this? Why are they saying cigarettes are bad for you? I put some thought into it, and I think what they're trying to do is move people over to vaping. Vaping is not a cigarette. So, anyway, if you were investing in tobacco companies, might the tobacco lawsuits hurt the tobacco stock price? Possibly, possibly. Anyway, you can look at this category by category, and now I'll give you a different example. This is the example that I just showed you on Morningstar, Parnassus Value Equity. Again, it's an example, folks. I'm not recommending you do anything here. Instead of $106 billion invested in fossil fuels, they have 52 million invested in one company. It's called CMS Energy. CMS Energy, you might question, why do they have any at all? Well, CMS Energy is, are they Michigan or no, Minnesota? And they are very much focused on sustainability. They have set a goal of becoming completely free. Actually, it was meant to be last year. They were going to be coal free, but Minnesota asked that they actually hold off for an extra year. But the goal, as I understand it, is by December 31st, according to their sustainability report, they should be coal free. They are also very much moving out of gas, and they are moving into sustainables and renewables. So one of the reasons that Parnassus has invested in them, according to the portfolio manager, is these folks are open to dialogue and are willing to be pushed further down the field into sustainability. Thank you, Paul. Michigan, Minnesota, they're right close to each other. Yeah. And to Paul's point, yeah, vaping, it's called the no smoke product. We could get into a whole discussion about that. Anyway, that is why they're investing in CMS. CMS is really making an effort not only to close down the 3 remaining coal plants, but they're also retraining the workers to work in renewable energy. So that is what I wanted to say on fossilfreefunds.org. It is yet another way to screen your investments to look at risk. Again, if you take a look at this, the whole point of this chart was don't put your eggs in one basket, diversify. But what I started to learn in the 1990s about putting a little here and a little there has expanded to discussions of supply chain, global political issues, and if this just looks like confusion, perhaps a model is what you should do. We have about 8 minutes to go. Let me stop the screen there. See what questions you folks might have. I don't mean to run us all the way to the hour. Um, yes, yeah, you're right, Paul. Renewable energy may not be renewable. Greenwashing. I learned a new term yesterday, green shouting. Interesting. Rose, what did you want to say?
I just wanted to chime in and get your opinion because some of our participants might be concerned about the Trump administration's ruling on ESG funds and how ESG shouldn't be used in terms of evaluating retirement investment options for retirement plans.
So I'm going to look up an article that I just wrote on the 6 factors. What the Trump administration actually said, well, I'm not seeing it come up, but I will send it out to everyone who's on this call because golly knows I certainly do blog quite a bit. What the administration said is that you need to consider, and again, this is a proposal. They didn't actually address ESG. They said, though, that you need to look at 6 factors when you consider an investment. Some of the factors include performance. Some of the factors include risks that you define as pecuniary or long-term relevant. Now, again, since it's in proposal form, this is not a law. But as I thought about it, to your question, Rose, it actually can help the ESG funds. Again, I promise my compliance department I will not talk about performance, and I will stick to that. But having said that, you can easily do your own research and see how ESG funds have performed. For example, something that's fraught with fossil fuel free or fossil funds, fossil fuel risk, possibly has had some rocky times of late. Who knows? Again, I'm not going to touch on performance. In terms of what does it mean to have a long-term risk? Paul's already pointed out some of them. But I would say climate change risk is something very much in the long term, but it's relevant. I saw an interesting article, and again, I'm not a scientist, but I certainly do follow along, that said that the time to start moving out of New Orleans is now. That by 2030, New Orleans and one other city down there, and I think it was Baton Rouge, are going to be surrounded by water. Now, somebody could say, oh, that's just hype, that's scare tactics, it's a real estate investor wanting to come in and buy all of New Orleans. I'm going to go down there and have a drink. I'm not going to weigh in on that, folks. Privately, I'm happy to talk with you one on one. But I actually think the six-factor proposal is favoring ESG. Now, again, that's just my personal opinion. Paul, have you read through the six factors, and do you have a view on that, given that you certainly are a 20-year veteran of the ESG space?
I mean, the main thing is about risk and what's important to risk. And, science, biology, chemistry, they don't, they advance without politics. And the reality is, if there is a meaningful physical risk or to your portfolio, that should be analyzed. The challenge is that sometimes the people interpreting that hear it as tree hugging instead of risk reducing. So the actual criteria are consistent with continued ESG, sustainability, fossil free, but people sometimes twist words in ways that either are not intended or not actually accurate. So think of the rules as risk reduction to protect you. In the past, for example, Intel, the computer company, had a venture capital fund in its 401k. The participants did not make money in it, so that became controversial. Morgan Stanley, the financial firm, charged higher fees to its employees for its 401k funds. So these are some of the key things to be conscientious of, like Green Retirement does, is are there reasonable fees? Are the portfolio selections reducing risk? Are you looking out for the benefit of the investors? So it's supported in Democratic organization in administrations, and it's attacked in Republican administrations. But the core principles are you protecting investors and reducing risk? And sustainable investing generally addresses more risks in more depth over a longer period of time.
Thank you, Paul. And folks, I did find the article on the 401k side, and I popped that into the chat box. You can also see that I directly address ESG investing, at least my 2 cents. Again, I'm not an ERISA attorney, but I do think it's supportive. So it has been interpreted as anti-ESG, but I think it simply emphasizes that you need a prudent process, a well-documented way by which investments were chosen. I know Rose needed to jet, so she is running for Congress, roseforcongress.com. So she has a call coming up at the top of the hour related to her campaign. Any questions, folks? I know we went pretty in depth here on the technical stuff, but again, to Paul's point, we're trying to diversify risk. Questions? Anything? Not? James, anything last from you? No. All right. Well, folks, thank you very much. Our next first Friday, which is, I believe, June 4th or June 5th, that's going to be on AI, actually. We're going to have an expert come in, talk about AI, uses of AI, and hopefully we can get the conversation around to the ethics of AI. So June 5th, thank you, Paul. It is sometimes a little hard to do these things on the fly. But yeah, June 5th, we'll be having a discussion on AI. What is AI? How do you use it? Should you use it? In any case, take care. The recording will be up soon for this particular session. Bye for now.